Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in company filings. Today we're diving into SM Energy Company's latest report, and let's just say things are getting a little more flexible in the world of credit agreements, which is always an interesting dance to watch. Before we jump in, if you like getting these simplified insights from the world of finance, make sure you're subscribed. And hey, we've got a growing Discord community where we discuss these things further. So check out the link in the description below. SM Energy Company is making some tweaks to its credit agreement, and this particular change seems to be about removing a bit of a ticking clock. They entered into a third amendment to their seventh amended and restated credit agreement. Think of it like renegotiating the terms of a big loan. Before this amendment, there was something called a springing maturity provision. This sounds a bit complicated, so let S break it down. Essentially, it meant that if certain senior unsecured notes, which are basically IOS the company issued, weren't paid off, exchanged, or refinanced by a specific deadline 91 days before their final maturity date, then the entire credit agreement, meaning all their borrowing power, would suddenly become due much sooner. This is kind of like having a grace period, but if you don't deal with your smaller debts on time, your main big debt suddenly becomes due way before you expected. The big number here is $50 million. If more than $50 million of these senior notes weren't sorted out, that clock would start ticking faster for the whole credit line. This kind of clause can put a lot of pressure on a company to manage its other debts very carefully, especially as they approach those specific deadlines. Now, what does this third amendment do? It gets rid of that old springing maturity provision. That is significant because it removes a layer of immediate pressure. However, it is replaced with a new condition for acceleration. The maturity date of the credit agreement will now be sped up if two things happen at the same time. First, if the total amount of senior notes and other unsecured debt that matures within the next 91 days goes over $50 million. And second, if the company S available borrowing under this credit agreement after accounting for those maturing debts falls below 20% of its total revolving loan commitment. So, it is still a way to protect the lenders, ensuring the company does have too much short-term debt bleeding into its main credit line while its borrowing capacity shrinks. It's a more specific trigger, but still designed to ensure the company stays financially healthy. This amendment went hand in hand with a semi-annual borrowing base redetermination. This is where the lenders review how much the company can borrow based on its assets, like its oil and gas reserves. The fact that the lender group unanimously reaffirmed the borrowing base and approved the amendment is a really positive sign. It suggests the lenders are comfortable not only with the company's assets, but also with the updated terms of the credit agreement. It's basically their way of saying they trust SM Energy's current financial footing and its plan moving forward. Looking ahead, SM Energy's common stock is traded on the New York Stock Exchange under the ticker symbol SM. Understanding these credit agreements and borrowing bases is crucial because they directly impact a company's ability to fund its operations, make acquisitions, or weather economic downturns. When a company has a flexible and robust credit line, it gives them the confidence to execute their long-term strategy. Now, let's look at this from a broader perspective. SM Energy is in the oil and gas sector, an industry that can be quite volatile. Having a more lenient credit agreement, one that removes a sudden maturity acceleration, can provide a significant cushion. It means they have a bit more breathing room to navigate fluctuating commodity prices and operational challenges without the immediate threat of a large chunk of their funding being called in early. This amendment is essentially an endorsement from their lenders, giving them a stronger foundation to operate. So, what is the story here? SM Energy has effectively renegotiated a key aspect of its debt financing to gain flexibility. They've removed a potentially harsh penalty that could have forced a swift repayment of a large loan. While a new, more nuanced trigger is in place, the overall sentiment from their lenders seems to be positive, indicated by the unanimous reaffirmation of their borrowing base. This suggests SM Energy is demonstrating financial stability and a clear strategy to their banking partners. In my opinion, this is a smart move for SM Energy. It reduces a significant risk factor and allows for more strategic financial planning. For investors, this kind of news, especially when coupled with lender confidence, generally signals a more stable operating environment. The key takeaway is that the company is proactively managing its financial structure to ensure operational continuity. The risks would typically lie in the inherent volatility of the energy markets, but this agreement helps mitigate some of the financial risks associated with that volatility. Alright, that is our breakdown of SM Energy's latest filing. What is your take on these credit agreement changes and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.